Good morning and welcome to the Morning Bell. I'm Robert, joined by Lizzie and Steve. It's Monday, May 11th, 2026, and geopolitical tensions are creating significant ripples across global markets. Lizzie, what are the main themes you're seeing in today's news?
Thanks, Robert. The dominant story this morning is the escalating Iran situation and its cascading effects across multiple asset classes. Brent crude has pushed above $103 after President Trump dismissed Iran's latest peace proposal, and Morgan Stanley is warning that if the Strait of Hormuz closes, we could see Brent hit 150 by summer. That's not just an oil story, it's affecting everything from consumer sentiment to central bank policy expectations. What's particularly interesting is how this is playing out in emerging markets. Modi is calling on Indians to reduce gold purchases and fuel consumption, citing severe risks from the war. That's a significant statement because India is one of the world's largest gold consumers. And when a leader tells citizens to tighten their belts, it signals real economic concern. Meanwhile, European oil majors are reaping between $3 billion and $4.75 billion from trading volatility around this crisis, which shows you how bifurcated the impact is. Some sectors are suffering, while trading desks are having banner quarters.
That's a major development with these energy price moves. How are you reading the market's interpretation of all this?
Markets are showing a classic risk-off rotation, but with some notable exceptions. The dollar is under pressure despite the geopolitical uncertainty, which is somewhat counterintuitive. Goldman Sachs just released analysis showing the dollar is significantly overvalued, and we're seeing that reassessment play out in real time as Trump heads to China for trade discussions. On the corporate side, we're getting mixed signals. Circle just raised $222 million from BlackRock and Apollo in a pre-sale valued at $3 billion, showing institutional appetite for crypto infrastructure remains strong despite macro headwinds. But then you've got stories like British Steel potentially facing full nationalisation under new government plans, and KKR taking a $560 million loss on a private credit fund. The divergence between winners and losers is widening significantly. What's concerning from a consumer perspective is that while Bitcoin and Nasdaq investors are celebrating recent gains, US consumer sentiment is turning gloomy, and that disconnect usually doesn't persist for long.
Given all these cross-currents, what does this mean for traders this week?
For the indices, we need to watch how they respond to this energy shock. The S&P 500 is in what some are calling a melt-up phase, with new top targets being set, but energy costs are a real headwind for margins. Looking at the S&P 100, we're seeing leadership narrow to energy and defence names, which is typical late-cycle behaviour. The index is holding above key moving averages, but volume has been declining on up days, which suggests the rally is getting tired. For the Nasdaq, the AI infrastructure theme continues to provide support, particularly with TSMC, benefiting from AI's next phase. But consumer discretionary components are starting to lag, as that sentiment weakness I mentioned filters through. The Dow is actually showing relative strength because of its energy and industrial weighting. Those old economy names are benefiting from the geopolitical premium. From a trading perspective, I'd be watching the energy sector closely for exhaustion signals, because these geopolitical spikes tend to be sharp but not always sustained. The key level for crude is whether it can hold above $100, or if we get a diplomatic breakthrough that sends it back toward $90.
That selectivity is going to be crucial for navigating this environment. Steve, let's get into the economic calendar. What's the picture looking like this week?
Thanks, Robert. This week is absolutely critical from a data perspective, and it all centers around inflation readings that could significantly impact the Fed's thinking going forward. The Cleveland Fed has already released estimates suggesting we might see a hotter-than-expected CPI print, and that's creating anxiety in rate-sensitive sectors. The official CPI data is coming later this week, and consensus is looking for a monthly increase of around 0.3% on the headline number and 0.3% on core as well. However, given the energy price spike we've seen with Brent above 103, there's real risk that the headline number comes in higher than expected. What makes this particularly important is that we've now had 2 strong jobs reports in a row, which the Financial Times is highlighting as a sign that the labor market remains resilient despite higher rates. When you combine strong employment with potentially sticky inflation, it complicates the Fed's calculus considerably. We're also getting retail sales data this week, which will be crucial for understanding whether consumers are actually pulling back spending in response to higher energy costs, or if they're continuing to spend down savings. The early warning signs from consumer sentiment surveys suggest we might see some weakness, but the hard data hasn't confirmed that yet. Additionally, we'll get industrial production numbers, and given India's push to increase coal-based steel capacity globally, we want to see if that's showing up in commodity demand patterns. The bond market is already pricing in some concern, with the yield curve showing that traders expect inflation to remain elevated longer than previously thought.
Those inflation dynamics are definitely the key variable right now. Lizzie, let's shift to crypto markets. What are the trends you're seeing heading into next week?
The crypto market is showing surprising resilience given the macro backdrop, but there are some important nuances beneath the surface. Bitcoin is holding above $80,000 going into the weekly close, and we saw institutional funds capture $700 million in inflows recently, which demonstrates that larger players are still viewing BTC as a strategic asset despite volatility. Michael Saylor is hinting at additional purchases after Strategy's Q1 earnings, and the company's CEO clarified they'll only sell Bitcoin in very specific cases, which reinforces the corporate treasury adoption narrative. The technical picture for Bitcoin is constructive but cautious. Analysts are pointing to $85,000 as the next major resistance level, and there's talk that breaking through that level would signal the end of the bear market structure. However, Santiment is flagging that bullish sentiment has spiked to levels that historically precede pullbacks, so we could see a healthy correction before any sustained move higher. The Cleveland Fed's inflation estimates suggesting a hotter CPI print create downside risk towards $70,000 if that data disappoints. One positive development is that 7 major mining pools, representing 75% of Bitcoin's hash rate, have joined Stratum v2, which improves network efficiency and decentralization. For Ethereum, the picture is less encouraging. ETH is down 35% versus Bitcoin over the past year, showing persistent relative weakness. It's testing $2,450 right now, which is a critical technical level. If it breaks above that convincingly, we could see momentum shift. But if it fails, we might see further underperformance. The one bullish case for Ethereum centers on AI agents driving tokenization demand, with some veteran investors betting that this use case could reverse the trend. We're seeing concrete examples like BitGet tapping into the AI boom with OpenAI-linked pre-IPO tokens on Solana, and there's $71 million in ETH being moved to Aave by Arbitrum DAO, showing the DeFi ecosystem remains active. Solana is in a neutral to cautiously optimistic position. It's benefiting from AI integration developments and privacy protocol discussions, with a Ripple veteran joining conversations around Solana privacy solutions. The ecosystem continues to grow, but it's largely following broader altcoin patterns. The sentiment across altcoins is showing some danger signs according to technical analysts, so Solana needs broader risk appetite to improve before it can significantly outperform. Overall, my bias for next week is cautiously bullish on Bitcoin, with emphasis on that 85,000 resistance test, neutral on Ethereum, pending the $2,450 break, and watching Solana for ecosystem developments that could provide differentiation. The key risk factors are the CPI data that Steve mentioned, continued Iran tensions that are causing whipsaws in risk assets, and the fact that CME is about to launch volatility products for Bitcoin, which could increase price swings in both directions.
Well, that gives us plenty to watch as we navigate this complex environment. The intersection of geopolitical risk, inflation concerns, and evolving market structure is creating both challenges and opportunities across asset classes. Remember, do your own research and consult with financial advisors before making investment decisions. The information we discuss here is for educational purposes and shouldn't be taken as personalized investment advice. Thanks for joining us on The Morning Bell, and make sure to subscribe so you don't miss our daily market analysis. We'll be back tomorrow to break down how these themes develop. I'm Robert with Lizzie and Steve, and we'll talk to you next time.